Hello, folks, and welcome to the Defiance Podcast. With me today, I've got Andy Johnston, one of the founders of 7 Mile Advisors, a very successful boutique investment bank based here in Charlotte. I've watched 7 Mile grow through the years, and Andy hasn't gotten to be too important to still grab a drink with me every now and again and let me pick his brain. So we're going to do just that today for the podcast.
Happy to do it.
Thanks for joining us, Andy. For the folks listening who don't know 7 Mile, can you tell us what you do and maybe walk us through a little bit of your history?
Sure. So we are an investment bank. We work with companies and investors to help them raise capital, sell their businesses, and in some cases find another business to acquire.
Banking, should they be thinking about an MBA, do you think?
I definitely think so. So I will tell you, I spent kind of 18 months to 2 unfruitful years trying to break in while in consulting. And I was getting the feedback that I was a way overqualified analyst and an underqualified associate at that point. And
Gotcha.
There are, for sure, if you're thinking in the traditional Wall Street firms or large scale middle market banks, you need to go get an MBA if you want the easiest path in. Not that there's an easy way, but the traditional way is they go to MBA schools, they look for strong recruits, they look for corporate finance majors, they look for that, work background. And that's still true today. I think that is a traditional way to do it. Our firm, we've hired several people without that background. We've been successful making that work. But I think for most firms, that is the traditional background and the way to get into investment banking.
Should someone thinking about investment banking and they're an undergrad, should they be doing a business degree, or does it matter less and they should think about the MBA?
Yeah, I don't think it matters as much. I would definitely say take at least one corporate accounting or corporate finance class just to have an understanding of how to navigate a balance sheet and an income statement. That's going to be true no matter what you pick. But I think at undergrad, it's cliche to say follow your passion, but boy, is it very clear to me that your major you should not try to pick your next 25-year career by your major. You would do far better to pick a major that reflects things that you enjoy learning about and projects you like working on, and there will be jobs waiting for you. So if you want to go to investment banking, yes, would it be easier if you had a quantitative degree than art history? Maybe. But if you show well and you, outside of your classes, you do things that demonstrate you're interested in corporate finance, they'll find you, get a good GPA, they'll give you a shot, show up. I mean, at the entry levels of investment banking, like a lot of jobs, it's hard work, it's follow through, it's showing up on time, it's anticipating problems and solving them, it's being detailed and diligence, and I think a lot of majors have that. And so you'd be better to excel at a field that really you enjoyed in school and then let that come through in your job interview.
Well, it seems like too, it isn't just that you're an investment. It isn't just I'm an investment banker. You're probably going to become an investment banker who focuses on certain things at some point in your career. So if you've got a technical background or a marketing background or some other things, it's probably helpful.
I think we happen to be pretty industry focused. I think a lot of investment banks are more generalists, and they would tell you it's a hindrance if you come in saying, well, I only want to work with clients that are in this one space. That's all I know, and that's all I want to work with. They'd be like, well, that's great, but that's not what we do. A lot of folks also they just respond to demand. A lot of analyst programs move you around based on where the demand is, and it's too early to specialize, I think, at that level.
I think that's great advice, whether someone's looking into investment banking or not. Thank you for that.
Sure.
So you talked a little bit about it. You and Leroy are at decision. Number one, you need to like it. That's hard enough. Number two, you need to no one else can have it. And number three, you got to clear the URL.
That's right.
And even now in the social media world, you got to be able to get a Twitter handle.
The hashtag.
Hashtag.
Yeah, exactly.
Absolutely.
God,
So
I can only imagine.
So in my world of technical services, as you probably know, most companies that start a company like a Level or you've done some work with Austin Rosenfeld, like a Macedon, they have in mind the first client that they're going to get, and in many cases you've already got it. We started Level in Asia Pacific with 2 clients already lined up, so that made it a lot easier to start the business. But obviously with the gardening leave, with the tight or workers, think about bonuses is just different. Can you talk a little bit about the bonus, the size of, like, what percentage of your overall comp? And
when you're an entry level investment banking employee, a bonus might be 20 to 30% of your base compensation. Very, very quickly that slides up to closer to 50%. And then as you climb the ladder, the bonus is oftentimes the majority of your compensation. For senior folks, it is 3, 4, 5 times their base salary. And As you become a senior person, it's also almost entirely driven by how much revenue you can generate. That is measured by clients you sign up and deals that you run. And then you become practice leaders. So you're kind of sitting on top of a pyramid. It's not unlike other professional services firms. You typically have, teams underneath you. You oftentimes start with the lowest person's bonus first. You have to keep them happy. And then if you're having a great year, you end up having a lot more left over to pay to the folks at the top.
I always say he or she who gets paid last gets paid most.
That's right. It's an ownership mentality. Exactly.
But one of the things I think that there was a lot of backlash against bonuses that were paid during this time in 08, 09, during the height of the financial crisis. To me, it seems like it isn't really a purely discretionary bonus. There's just an understanding that I'm getting this.
Yeah. I mean, the surest way...
But it's called a bonus, but it's not really.
I know. But the surest way to make someone quit is you zero out their bonus. Like that is the ultimate Wall Street firing, is you never fire them. You just give them a zero bonus and let them read between the lines about what that means. So
yeah, I've heard about an investment bank on the East Coast that's had a few people leave because bonus time didn't quite live up to expectations.
I will say, so one of the things we wanted to make sure we did with our bonus program is we tie it directly to the role you play on a project for a client engagement. And it's very clear, the percentages are spelled out, and we're very transparent about that. So I personally don't like the big black box approach to that, which a lot of investment banks do, which is keep everyone happy, keep doing the right thing. And then once a year, we'll all have this very tension-filled moment where we sit down and describe what your bonus is going to be, and then nervously wait the next week to see if you show up to work or if we just cause you to quit and go walk across the street.
Well, not that it's the same industry related to it, but on the show Billions, have you watched that
yet?
So have you watched recently? They went through bonus season at the two hedge funds.
Yeah, I know. It's I look, I get it. It has its merits. I think for us personally, it was just better to say, look, if you do the following, here's what you're going to get paid. Yes, we have a discretionary bonus on top of that, but I tell people, if you are counting on that to be the majority of your compensation, that's not how it's supposed to work.
Yeah. And you get why the discretionary is nice, because some people work their ass off and they work well, and just the dice bounce the wrong way.
Exactly.
And you need to be able to reward them.
Exactly. And look, we get it too, and that's why we still have an annual bonus, because part of the reward is doing the right thing. You may not have had a direct role in a project, but did you come to them and say, look, I encountered this buyer, this investor through my client experience. I don't really have a stake in the outcome. I'm not going to get paid on it, but you need to go talk to them. Or I think the right move is to go do this. We want to encourage that kind of behavior versus everyone's a mercenary, and if it doesn't pay them, they're not going to do it.
So you get the first client. Lots of different business models out there, but I think it's probably pretty standard for investment bankers, correct?
Yes. I think ours is nothing that you wouldn't find at other firms. So there's an upfront retainer, which is like a consulting fee. It's usually just a fixed fee of some kind. Maybe it's a once a month or it's a one-time fee. And that gets the engagement started. And then we're working for a transaction fee. We get, a single-digit percentage usually of the transaction value. And if we're on the sell side, it's for the total value of the company. If we're raising capital, it's for the dollars raised for the business.
Is it a higher percentage for raising capital?
It usually is. We would argue that's usually much tougher. And the dollar amounts that we're involved in are just smaller. And then on the buy side, it's a very similar model. We're getting a percentage for the value of the company that's acquired. So for us, it's a lot of fees at risk. We're not the ones writing the check. I many cases wish that was the case, where I could buy someone or sell on behalf of my client. But we've had a few situations where literally the day of closing, we get the phone call that the deal's not going to happen. Someone's had a change of heart and they're just not going to close the transaction.
That has to be the worst, because I've seen you working on processes before.
Yeah.
It's
There's
no
nothing
joke.
you can do. There's nothing you can do.
And clearly your retainer isn't why you have a team of 5 people working 100 hours a week.
And there, exactly. It's a commitment for sure, but no one's getting rich or this business model does not work on retainers. You need to close transactions for this to make sense.
Are there ever clients where you say, you know what, this is just so good that I'm not going to charge a retainer? Or
it happens. And sometimes in competitive situations, you have to be flexible with that kind of model. Our number one concern, though, is when you end up in that kind of relationship, I am just a guy throwing an idea at you. There's no real penalty for not doing a transaction. Weekly status calls become skipped every other week. I can't really make time for that buyer meeting. I don't know if I'm going to get to that requests they put in, because at the end of the day, we're just kind of like, yeah, it's nice if it came together, but that's not really a process. Now, there are other folks who won't pay a retainer, but it is assuredly going to be a transaction, and that could make sense for us.
Got it. So I've heard that all bankers prefer sell side versus buy side. First of all, is that correct? And is the reason because there's way more ways to lose a buy side deal?
Generally, I'd say that's true. I think that is also true, that if you ask most bankers, they would say generally that's the case, primarily because of the likelihood of a deal closing. Mm-hmm. So if you're a buyer, there's almost no consequences to not buying a company, right? You could hire a banker, you might be out the retainer fee. They could show you 50 amazing ideas. You could explore 20 of them. You could take meetings. You could put term sheets out. And if none of them close, you're probably going to be fine. Your job is not going to be really that much different. And your personal net worth is probably not going to change that much. It's a little different if you're working for a private equity-backed group and they've got an exit plan, and part of it almost requires the deal get done to hit the valuation they're looking for or to line up with a buyer that they have in mind. On the sell side, by the time we get hired, it's very clear, who we're working for. Our interests are highly aligned. And a lot of times we're working with middle market companies. They're owned by management. We are making a life-changing amount of money for the owners. So the likelihood of a deal closing there is much higher. And we get more control. So we are in a process at that point where we control the seller. We control who gets access to them. We generally have a lot more power to negotiate with investors and buyers versus on the buy side, where kind of our only move is to walk away.
And with both of them, do you require an exclusivity agreement? Or?
We do. We've cooperated in a handful of times. We had a partner in the UK that we did some joint advisory work with that was very helpful with a few clients that had a European focus or where European buyers were likely to be part of the equation. But generally, it's very tough to work with someone opportunistically or not exclusively. And the way we put it is, look, you don't want to be in a mode of this is yours, mine, and ours. And now I'm in competition with the board and with management, and I hope I get to that candidate before they do. And we want to be able to tell them all our ideas. If you think about this concept where there's some buyers who might want to do this deal that I don't want to pay you on, well, if I expose you to one in my generating ideas phase of the project and proposing a list of candidates, I don't want there to be a risk where the CEO says, you know what, I actually know those guys. I'm just going to call them. Great idea. I'm not going to pay anything, but I bet you they'd be really interested. And I don't know why I didn't think of it, but I'm going to go call them now that you brought them up. Like that.
Or they think they thought of it, right?
Yeah.
That happens. I mean, and it's not nefarious. It's just human nature.
Yeah. And people intend to go into these things with, the best to tell them, look, I really want to get the deal done with you. I'm here as an advisor to help make the deal happen. But we're going to push things on a timeline to make sure, one, you don't distract the company with, a prolonged process, and two, just keep them honest. Don't go give them an excuse to retrade the deal down to get you close to the finish line only to announce the new worser terms, knowing that you have no other options. If they don't believe you have another option, there's almost every incentive out there as a buyer to kind of test the bottom and see what's going to cause you to walk away.
One of the things that I think about in this, thinking about should I run a process, is I had Greg Brown on, who runs the Charlotte Angel Fund last week, and he talked about all the different ways to value companies, and it's very clear, and especially going to business school, we learned like there's 20 different ways you can value a company, and frankly, for a lot of companies, none of them apply. The only real way to value it is in the market, and so if you're only talking to one company, it's not as if you can say, oh, great, here's my cash flow, and there's no assumptions in this model, and here's what I'm actually worth. It's you need to get out in the market and see what the different viewpoints are, and frankly, my guess is even the entrepreneur doesn't really, or the owner of the company doesn't know what their company's worth.
They have usually heard some amazing stories at cocktail parties. They've read the headlines about deals that are so outlandishly unusual that they grab headlines and get written up in financial press or technology articles. And they anchor their expectations sometimes in a level that's just not sustainable with the market. So yeah, oftentimes we are, for example, talking people down from where public companies trade. So unless your company is at that scale and publicly listed.
No, you can't use Cognizant or Accenture's multiple.
It is exciting to think about it that way, but I would view it as a ceiling, not a floor. Mm-hmm. And also, look, some people start a company, and I think this is true psychologically, knowing that they always wanted to sell it to some buyer. Especially, I think, in marketing services, there are a lot of people who left a big ad agency thinking someday I'm going to sell this back to like that. That will make it
to a DPP
to
or
Omnicom. Like I'll know
yeah.
I'll made it. I will have made it when Omnicom or Publicis buys this firm, right? And that's always been their dream, and that's great. But we can tell you, we talk to their corp dev guys all the time. They see 100 deals a week come across their desk. By no means are they going to chase one down and overpay for it just because there's an emotional attachment to it. So even if you know who the buyer is and they're interested and they're at the table, a process always helps. Get a second opinion, take a look around to see what else is out there. And for a lot of people, they just haven't done that for a living, right? They've been busy running the company, hiring people. I would do the same. It's very hard to be outward looking when you're focused on, especially a high growth business. You just don't have time to check in with potential buyers and get a temperature read from them and talk to previous sellers and look at deal comps. We're doing that all the time. And we can very quickly give you an assessment of, you know, your range of outcomes looks like this. Your company measures up well on these fronts. It needs improvement on those fronts. And if we were to go to market, this is what we think the outcome would be. I also think a big mistake people make if they run a selection process with bankers, it's very easy to win an engagement by promising you the highest valuation one has ever heard. Like if all you did was stack bankers up by the price they quoted you, you'll make a huge mistake. And
did you read about
matter at the end of the day?
And how do you go about recruiting talent?
So we grew, I think, very cautiously and carefully. One of our first hires was one of those encounters in the building. There was an accounting firm in one of our first office spaces that was on the same floor. It was a German accounting firm that had a U.S. office in Charlotte. And one of their employees, she was a recent UNC Charlotte graduate in accounting. We just got to talking one day in the lobby about what we do. And we knew at that point we needed to add someone with primarily financial analyst skills to help add to that capacity. And we were looking for someone that was comfortable working across multiple clients, had a really strong international accounting background. That became important to us. We have a lot of cross-border deals where you have to be comfortable working in different countries and across IFRS.
That's not GAAP. What do they call that?
IFRS.
IFRS.
Yeah.
Okay.
And she's just a great hard worker, Christina Sergeyeva. She was actually born in Russia.
Yeah.
And fluent in a couple of different languages, very comfortable with international travel. And so we look at background. We've recruited a couple of people who had background in our industry and kind of taught them investment banking, just knowing that they had IT services or professional services in their background. It's a little cliche maybe, but we look for good team members. I think this is a space that is filled with people with big egos, and we try to avoid that where we can. We have a model where you have to be comfortable sharing ideas with people, working alongside them. There's certainly deal teams are very clear what the roles and responsibilities are, but the way our firm is set up, we mentioned those buyers. Everyone has a list of buyers that they're responsible for, and everyone needs to bring their best buyer ideas to our client engagements and take those clients out to the buyers they're responsible for. So there is a lot of dependency on your teammate to be successful in a process, and we're looking for people that are comfortable in that environment. I think in some investment banks, it's very much a silo. The guys on the team are the only ones making the call. There's a rainmaker at the top. You show up to the meeting, you better not talk. You let the rainmaker do all the talking. And as you advance, that rainmaker might let you start saying 5 words in a meeting. We try to get around that completely. So we look for people that are comfortable working in a team environment. For sure, there's a finance aspect to it, so you have to be comfortable with those kinds of concepts. Easy to get along with, fun to hang out with. Those are important qualities. But yeah, look, it's hard. Good talent's hard to find.
They have to be very entrepreneurial in some cases.
Yes.
Just as an example, when we were selling a Mentor at a Red Hat, we had a landlord that we needed. Red Hat required a signature that, hey, when we buy this company, we can extend keep the lease going. 'Cause it wasn't a huge office. It was maybe a 40-person office, but it was important to them, and probably more than it needed to be. But I don't know why it was such a big deal. But in any event, we couldn't get a hold of the owner. The property manager couldn't get a hold of the owner, and he said, "No, we're not going to have unless you tell us who it is." And he said, "Well, I can't tell you who it is because and just the skill that they used to negotiate and go back and forth. It was a very entrepreneurial thing that they were doing, and I remember being very impressed that these are guys who can spreadsheet out and get on a million phone calls just delivering a generic pitch, but then when they're throwing a curveball, they step in for you and get it done.
I think that's right. Yeah. Resiliency, that's the good think on your feet, not wait to be told what to do, but to be proactive and say, there's a problem, here's how I'm going to fix it. Good communicator too. And then we value people who are comfortable picking up the phone and calling people they've never talked to before and introducing themselves. And I think to be very good in this space, you have to be able to establish credibility very quickly. You have to be comfortable kind of stepping out of your comfort zone and talking about things that maybe you don't have perfect knowledge of, but you need to advance the conversation, and that's kind of the only way to do it. Take a risk, and maybe you look dumb. Maybe you'll say something that turns out not to be true, but we'd rather you do that than stay quiet or just back away from the conversation. Say, well, I don't know enough to weigh in, so I'm just going to sit back here and let's see what happens.
That's great advice. What are you hearing about the macros from your clients?
Yeah, I think an early stage company, so it's somewhat industry dependent. If you're in a high growth sector like software, there are more early stage, I think, financing options available to you because there's a perception that with a modest amount of capital, a huge amount of revenue growth is possible. So if you're turning out widgets, especially if those widgets are pieces of software that don't require a lot of labor to scale.
Now they don't require any hardware or even software licensing. It's cloud. It's on demand.
The barrier to entry is so low. Exactly. You got an AWS subscription and a really smart idea. It's like a virtual drug company. You might just have a compound, and you could outsource the entire process of research, approval, distribution, all the way through to getting a major pharma company to buy you, and you might have had 10 full-time employees along the way.
And you add in additive printing, and you add in some of the new injection molding techniques, and it's
contract manufacturing.
So much cheaper to do things.
So product, software especially, we deal, with technology companies. They have, I think, a wider range of early investment options. If you're here in Charlotte, it's still somewhat limited compared to other locations. Your best bet is still to be in Silicon Valley. But I think the secret's out, and there are funds out there that now look for deals, and they don't care where you are. They'll get on a plane. They'll meet with you virtually. They're open to anything. But yes, it's easier if they can get in a car and drive down and see you if something's going wrong than have to get on a plane to meet.
Yeah, a company I invested in recently raised a big round of follow-on funding, and Rise of the Rest fund was part of it, which is a fund that Steve Case started under Revolution, I believe.
Oh, yeah.
For investing in cities outside of DC or New York or San Francisco or Austin.
It's a knowledge economy. You'd be foolish to think that only the best CEOs or innovators live in major metros. It's true. Services companies, I think you're more limited in your early investment options. There, I think you're more in the friends and family round for a while. I think most commercial banks and traditional lenders really don't want to do more than like a line of credit, and that's going to be controlled by your assets. And most services companies, their assets are accounts receivable, some laptops, and maybe some office furniture.
Standing desks.
Yes, Veridesks everywhere.
Veridesk Pros. I think that was the only thing on our balance sheet other than the AR and cash.
Invest in chronic back pain treatment centers here in about 10 years. Tattoo removals and back pain treatment. It'll be a hot commodity. Yeah, so I think for services companies, they, in my mind, sometimes at the early stage, they make an assumption that because they work with technology, perhaps they're going to be treated to VC level of interest. That's just not the case. It's harder to grow a services company. You need to hire people almost in lockstep with revenue growth unless you have a product or some way to generate revenue faster than you can generate billable hours, and that's almost never the case. It's also generally true that more investors want a product company than want a services company. Like we've gotten to know the investors that really like services companies. They're out there for sure. But that is a minority of the universe of private equity for sure that's out there.
Yeah, it's amazing to me how much private equity money is in services. It's still minuscule compared to products, but you see great names like Columbia Capital and Carlyle Group own services businesses.
Yeah, and I think they recognize that once it gets to scale or there is some unique technology tied to it. So if you're implementing Salesforce, if you're implementing AWS, and you are the biggest in a sector, and especially a highly regulated or a really tough sector like healthcare or financial services, they recognize that. But what they really want are barriers to entry, scalable growth, leverage. So a lot of people overlook that. So if your business can't really support a high amount of debt, you've kind of violated almost the fundamental principle of a leverage buyout. So if a private equity group can't get comfortable, there's going to be a lender there to help them lever up their investment. it's very hard for them to get excited about putting in money at a high valuation.
It's funny because I have this discussion a lot. People talk about things they should be thinking about at the time that they start the company that could prevent those outcomes from being harsh or one-sided or...
That's a great question. So equity is forever. I'd think about that. I think a lot of people make decisions at the outset around ownership splits that they regret down the road, thinking there'll be a chance to correct it or change it. That's often very hard to do. Signing up an equity ownership agreement, barring some major event, that's going to be in place permanently. You might be able to dilute people down with additional equity or outside investors and things like that.
How do you get around that? Do you put in a buy-sell agreement where there's a...
Yeah. Well, one, I think it's thoughtfulness about, ownership split at the outset. Are you going to tie it to invested capital, or is it going to be sweat equity? If it is sweat equity, be very clear on the terms that are necessary to get that. I think beginning with the mindset that the people that are most important to an investor or a buyer need to have some ownership stake in the business. I think a lot of times we get involved in a company, it's owned by one person, typically the CEO, and as it becomes clear that there's a really strong team underneath them, we know what's going to happen. A buyer is going to show up, meet the company, get to know them, and say, look, I noticed in the cap table there's only one entry, and it's you. However, we're very impressed with these people, and we're pretty sure this company wouldn't be here without them. And most importantly, were you to leave, we were totally dependent on this team. If we go through a transaction and they get nothing, they're going to be extremely upset and very inclined to leave and not want to stick around. So either you cut them in now and decide how to allocate that ownership stake, or we're going to do it for you. And we're just going to take some deal value away from you and distribute it out to the team that we think is important to the deal being successful. So I would get in front of that. A lot of people do. Some people wait till the last second, I feel like, and then they're, scrambling. And there are ways to do that are, with some planning, are a lot more effective, tax efficient, work the way you want them to work, versus waiting till 90 days before you're going to close a transaction. And now you're kind of boxed in and you've got to get something done quickly.
I've seen that a couple times where the tax consequences were mind-blowingly awful. Yeah. And if just a little thought had been put in a year or two earlier. Long-term
capital gains is an amazing thing. And if you don't qualify for it, it is almost punitive to see what people have to pay between federal and state ordinary income taxes. So it's a boring and dry subject. I get it. But when it becomes real, and I think to some extent too, people after the .com blow up and the 2008 meltdown, they looked at things like equity and phantom stock, and people are like, that'll never, who cares? We'll do whatever. That'll never, what are the chances this really becomes liquid or has value? And now this chicken's come home to roost, and you're like, oh gosh, I can't believe I gave, this admin.
When you write a 60% check.
Yeah.
Because in some cases you're dealing with double taxation, right? Yeah. Because it's a C Corp and it's an asset sale as opposed to a stock sale.
Exactly. So tax planning, estate planning, do it at least a year before you think there's going to be a transaction. It might feel painful to write the check to a lawyer now or an estate planner now to put the plan in place, but when you're saving 6-7 figures worth of taxes at closing, you'll thank us that you did it. So it sounds like you get it.
The best is our mutual friend Austin Rosenfeld, who was on the podcast, who literally moved to Texas.
Yeah,
there's no state income.
A Redskins fan moved to Texas.
So obviously you've talked a lot about deals in the tech services space. What are the trends here that you're paying attention to now?
The cloud dominates everything.
And by cloud, you mean public cloud? You mean hybrid
sector? Cloud? If you're scaled up over 20 million of revenues, most tech services companies need to do at least 30% gross margin, 40% is better.
So gross margin more important than EBITDA in your mind if you're growing that fast?
A little bit, yeah. And, a healthy growth rate. So at least 15-20% year-over-year growth. And almost as important is a good track record of growth. So 2 to 3 years of consistent growth. People get very nervous about the one bad year in 3 being a sign that there's something to this business that makes it hard to predict going forward. That tends to be, in this market, maybe a 7 to 10 times EBITDA type of multiple. I still think valuations are tied back to EBITDA at the end of the day. If you have 15% EBITDA, you're doing a pretty good job. If you can couple that with 20+% growth, I think you're in good shape. I think financial sponsors have gotten very aggressive. I think maybe 5 years ago, they were conservative. I think it helps now that debt is very cheap and widely available, so they can get aggressive and rely on a debt partner to help them get their own evaluation. I think they've also raised just amazing amounts of money. I think there's tons of articles written about how much capital has been raised.
Apollo, 23 billion, Carlyle, 18 billion.
You literally can't wrap your head around how much money, and that is, trickled down to mid-sized funds and the guys who look for middle market deals.
Well, and to your point on we talked earlier about buy-side work, and they're not allowed to put the money on the sideline and wait for a recession. Their investors want them to put it to work.
The worst thing they can do is say, I couldn't find a deal and give it back. That's not why these general partners raise the money. They want to deploy the capital. Yep. So money wants to find a home. You have lots of people showing up competing for good deals. And it also, I've learned over time too, the stock market absolutely drives expectations. If there's an expectation that the market will keep trading in general at this earnings multiple of publicly traded companies, people will buy underneath that expectation, thinking that is a very likely exit. Either I'll take this public or I'll sell to a public company, and knowing that they're going to look at where their stock trades, and that's going to translate into a view on where they can buy a company and still be accretive or have some upside for them as a buyer. But yeah, right now we're in this, pretty amazing bull run of capital being available. There's a lot of capital chasing, not that many deals relative to the amount of money they've raised. And there's a stock market, that's been very elevated from a valuation standpoint. And it is a seller's market right now. It is a great time to be a seller. I can tell you that right now. It is a lot of people showing up on deals, a lot of people looking past issues that would keep other people out in normal times. And I think the underlying economy is still very strong. If you're selling into corporations, they have a lot of budget. If you're in tech services, the IT budgets are flush. Another trend we've seen is that the marketing people, they got the budget used to belong to the CTO now, right? Digital advertising, digital media, it is running the show. And a lot of technology companies have morphed into this kind of hybrid digital agency model where they're putting a marketing campaign together with branding and customer demographics and speaking the marketing language. But underneath, they have a lot of engineers and developers and consultants. And that, again, it's pulling a lot of people into investing in marketing services and digital agencies at valuations that weren't thought of in the past. But the expectation is there's just going to be a lot of demand and growth in that sector.
Yeah, I could see that. What a time to be alive. Can you speak a little bit about the concept of a carve-out? I think you talked about you doing a carve-out where you say, hey, these 17 firms are the ones that I'm putting a tail on, and if you sell to them, then I'm going to get paid. But I believe there's a carve-out up front, which is I'm already talking to these companies. You're going to get less of a fee if I sell.
Yeah, we might have a concession or like a list of companies that we would give a different treatment to, where we would say, hey, if you're already at this point and a deal closes with them in this time frame, that's a different fee outcome, right? Mm-hmm. So if you really did have a term sheet already in place, and we had a deal like this actually. That closed recently, where there's a great buyer. We'd put lots of deals in front of them, really liked them. We invited a company to attend our conference. We have an annual conference, about 200-300 companies show up. It's a mixture of buyers and sellers. They hit it off at the conference. They kept talking. They got to the point where they're ready to do a deal. The seller hired
Ultimately,
us.
I'm in the process of talking with a friend of mine about opening up a professional studio that we actually sell to other folks and do the services around the editing and everything. Yeah. That probably, I think we're going to get going in the next couple of months here. But the idea is the more important thing than the quality of the production to me is the quality of the interview, the quality of the information that it gives to the people listening.
I'm being sincere when I say, John, when I talk with you, I'd never have more do you know follow-ups than when I talk with you. Like you have the most interesting network of people. I have no doubt that you can go for years if all you wanted to do is create podcasts and never run out of people to talk to and content. So
well, we'll see. I'm
great.
enjoying it so far. It's great to sit down and talk with folks like yourself. So I'm gonna let you go. I really appreciate your time. Thanks for coming by, and I'm gonna have you back again soon. Maybe when the recession
I look forward
hits.
to it. I want to see the studio once you get the studio up and running.
Absolutely. All right. Cheers, Andy.
Thank you.